Okay, hello everyone, and thanks a lot for joining us on this second Lunch and Learn, where we're sharing digital insights on the future of venture capital. And Consilience Ventures has kindly reached out to pull together this series of content where we explore how the venture capital industry can create a digitized model for progressing the industry. All industries have digitized, and we heard last week from Kevin how a model was created to build an ecosystem, a valuation mechanism for attributing value not only to the startups in the system, but also to mentors, advisors, and other community mentors based upon how they contribute towards building that ecosystem. As part of the journey, we're going to invite a whole bunch of experts that are working within the Consilience Ventures ecosystem and hear from them how they're actually getting engaged and what a contribution from an expert typically looks like. So for the next series of 4 or 5 sessions, we're going to invite industry experts from different industries to share their views and also share how they are getting involved. So as part of the second poll, we'd actually like to understand which industry you're from. And I'm literally going to launch that poll now. But as I do that, we can see that on this call, I've just shared the results. We have the majority of you who are domain experts, which is good because that's the theme for today. Also investors, 37%. 11% of you are startup founders, and then corporate and none of these. But please share your comments and let us know which industry you're from. Whilst we're doing that, let me launch poll 2. Which sector are you from? So the subsequent sections that we're covering in more detail are space, AI, which is happening next week, sustainability, and medtech. So those are the ones that are coming up. Today's session is focused all around valuation. How do you value a company? And what are some of the considerations for that valuation model? So which sector are you from? 81% of you have voted. Let me end the poll and just share the results so that we can see who we've got. The majority, again, as last week, in internet and technology, followed by consulting. And then we've got financial services, healthcare. And last week, we did have some property experts who were not here this week. We put it on the poll for you. Anyway, there we go. So let's jump into the content. I'm going to try to go to the next screen. There's the results, by the way. And Mark, I think if you could progress me to the screen. I'm not sure why, but I'm not able to progress the screen.
I don't know why that is. There we go. I'll do it.
All right.
There you are.
So basically, we want to break this up into 3 key parts. The welcome, which we've just done. And then it's a lunch and learn. So grab a sandwich, take some tea, and then hear from Mark Edwards today on valuation within the community. And then the third part, which we'd really like to get your views on as well. How do we build the community? How do we get deeper conversations? What sort of content can we put together so that we can get more out of this? And SU's mission down there at the bottom, for those of you that have not heard of SU yet, it's to positively impact 1 billion people in the next decade using exponential technologies. And it's nice to see how Consilience Ventures is using blockchain technology, which is an exponential technology, to create an ecosystem for the VC market. I can't go forward, but now, Mark, over to you. We have Mark Edwards, who is part of the CV network, and I'm going to go straight over to you, Mark, and please introduce yourself. How did you get here? What's your background? And let's hear about.
Okay. Hello, everyone. Yeah, my name is Mark Edwards. I'm the founder of my company, Certis Financial. So if you like, my entire sort of business career has pretty much been spent partnering with business, partnering and helping them and connecting their ambitions, basically, between what they want to achieve, finance, and then the actions that attach to that. So I've spent my time doing financial management, model design, structuring large outsourcing deals. Excuse me, adjust this a bit better. That's better. And strategy, particularly in the last sort of 4 or 5 years. I've worked across multiple sectors, from minerals and aggregates, petrochem, into IT outsourcing, and then into the outsourcing business of an investment bank. So the whole way along the journey, from small little companies, incomplete records, all the way through. And with Consilience, my focus is very much around financial and commercial performance. So it's working with both Consilience and its portfolio companies in order to achieve the objectives that we've all signed up for. So that's kind of my story and what I'm doing. And outside of obviously Consilience, I have other clients with whom I do work, such as Interim FD. So investing my time in a model. So sort of the if you like, the premise of what we were here to talk about was, when you invest your time, what does it look like? What do you do? How long does it take? And what is the value delivered? And really, the only real way to sort of bring this to life was to bring an actual real life case study, a real life investment, and something that we're working on today. So.
And as we were doing the kind of run up to this, Mark, it's interesting to hear that you've worked with companies that are everything from sub 1 million portfolio all the way to 700 million in terms of size. And it's interesting that some of the core principles, whether you're very small or very large, they're quite intact. And they are
very similar. It's sort of when you work with a very large company, 700 was the biggest million. There are lots of they're almost like little small cluster companies. There's loads of almost like little startups, almost in a way that a startup is almost like a large project for them. So obviously the financing bit is a lot easier because you don't have to go and pitch to anyone. But in fact, the components and the way you put it together and the outcomes that you're looking for and the way that you drive it is absolutely identical. So that's really, so whilst when you're working at that sort of larger level, there is more of a wash, and there is a tendency to be a bit of a disconnect between cash and reality. I mean, I was talking to Mitesh before we did this, and I've seen instances where tens of millions haven't been billed for a few months because there's a billing issue, but no one notices. So
the journey started here in 2019 with you meeting Kevin.
Yes. So here we go. So my own journey. They thought, as one of the experts, what happened to me. So in September, well, in the summer, Kevin and I met. September, we pitched to each other, and during that process, when we went through it, it was clear that we could work together and do hopefully some good stuff. However, I didn't fully understand the CBDS, which I know will be, for people who haven't signed up, might be something that is either a concern or something you want to learn more about. I think my sole question to Kevin at the time was, is it regulated? Have you been authorized? And the answer was obviously yes. So I decided that the issue was probably more with me learning and understanding it more, and I should just put my running shoes on and go for it anyway, which is what I did. So, and obviously as time's gone on, I've understood it better, and it was the right decision. So my original focus was to build the financial model that the startups get loaded into. So it needed to be consistent. It needed to have the same no matter, because basically what you receive from startups does vary. Some are absolutely bulletproof, others really aren't very good at all. So what we need to be able to do is to normalize that and build something through that gives us a clue as to whether or not, financially speaking, they're going to make it. And also during the process, I joined the DD team. We looked at the first 3 or 4 investments, and we worked through a few of those. And that was a good way of testing the model. So as the financials came in and came through from the startups, we were able to road test it and have something to reconcile it against and make sure the answers we were getting were consistent.
And so what are some of the valuation principles there? Could you mention some that are built into your model that some of our listeners would need to bear in mind?
Sure. Our model is based around cash, is the management of cash, and making sure, because no matter what you do within any business, ultimately you have to pay your bills, and it is all around cash generation, and it's all around value creation at particular points in the process. Obviously, not all businesses startups rarely make profit in the opening few years, and really the second part of the model is we untangle the P&L and balance sheet to understand where the value creation is. And there's a particular point within the model where we can identify that and see whether or not the characteristics fit value creation. So it's driven by cash. And the second component, obviously, with a lot of AI, a lot of data, the second element is the data piece, which you almost have to strip out. So the value creations in 2 parts. So that's in summary what we do. So bulletproof numbers, real outcomes, real measures, real volumes, and a commitment to deliver. And all of that, when it's right, it literally just clicks together and you can see it as clear as day. When it's wrong, it also stands out too. So at the moment, I'm working with 2 portfolio companies. And we're just going to flip over and we're going to talk about the one in the box is the case study. I work with both Cyme and Cerebron, and Cerebron will form a part of the case study that we're going to work through now. I've spoken about this once or twice before, and on both occasions I absolutely failed to explain what they did. So I think at this point we'll just take a couple of moments to take a quick look through the box. So Cerebron's job, the problem that Cerebron is solving is within the insolvency industry, there is no end-to-end process. There are lots of sort of cluster bits of software that manage different components, but there isn't a case management and case. The best way of describing it is probably a standard case, which is sort of a little bit further down. A standard case is about...
Is a case something that a lawyer will pick up and you'll see, okay, this company is going insolvent. I've got this amount of information. It's come from these kinds of sources.
Correct.
And then the solicitor will then take that case upon and try and figure out where.
Yeah. Generally, the structure is there's a lead lawyer who controls generally 70% of the debt. They then have a lead IP, and the IP then works with all the creditors. And a standard case there, as you can see, is 10,000. It tends to be personal. This particular case is a personal one. So that's generally what they look like. What Cerebron have built is there's a huge administrative piece of work to get all those creditors lined up. Everybody understands the case, understand the level of debt, and then manage the debt through a 5-year cycle. And there's a duty of care with the person owing and paying that needs to be administered, and bringing in AI into the sector and being able to take out a ton of admin makes a phenomenal difference. Because at the moment it's all in paper and boxes, so it's quite a jump. It's almost a 2 evolution jump in what they're doing.
Yeah. So the legal profession is renowned for being bogged down in paper, and probably one of the last ones to be digitized. So
the creditors could range from local government all the way through to classic credit card. So they all come in different formats. It's all None of it's standardized. So you have to literally take a physical statement and load it. And that's really, so this then pulls it all together in a single case with a single view. And it fires the reports in two different directions, one up to the lawyer and the other out to the creditors. So in all directions, it takes care of the reporting, which also currently is clearly manual.
Yeah. So you mentioned about the unsecured debt market. This is essentially unsecured debt in the UK.
Yeah.
And in the case that there's any kind of breach or default, the process for actually recovering that default by the creditors is an overly cumbersome and manual process that is timely because there is no digitization. And so this solution will help to digitize all those cases, bring them to your fingertips, and then use some kind of machine logic to do some matchmaking. But how big is the insolvency sector? It sounds like it's fairly large. Number of cases that are being used in across the country. And is this literally, is this a region-specific solution, or can it be global?
This is currently, it's built for the UK. Second market would be US. So,
okay. But the technology used can be global.
Yes.
Okay.
Yes. I mean, the workflow will be different for the US, but the actual functionality is more or less identical.
All right. So maybe this is a good point to actually ask a polling question. And if there are people on the call that can maybe have a guess at how big this market is, I'm going to launch the third poll just now. So, according to PwC, what is the amount of unsecured debt in the UK? Is it 100 billion, 150 billion, 200 billion, 250 billion, or 300 billion? I guess so those are quite large numbers, aren't they? All of them in their own right.
It's just cash that's floating out there.
And to one of your points earlier, cash being king. Okay, let me just end this poll now so that we can take a look and share the results. So what did you guess? 39% of you guessed 250 billion, followed by 36% at 300 billion. So what's the answer, Mark?
300.
300 billion.
Yep, and it's forecast to hit 380.
By the end of the year, or when?
Over the next 5 to 8.
Okay, cool.
So, and it grows, just to give you the other statistic that kind of blew my mind a little bit, was the fact that it grows by 80 million a day.
Wow.
Obviously there's repayments coming back in, of course, otherwise that wouldn't work. But 80 million a day of unsecured credit is taken out in the UK every day. So you can imagine the risk. And in terms of, for this company, and given obviously the current climate that we're living in, you got that?
A little bit more.
Okay, cool. Yeah, and given the current climate, the insolvency practitioners are going to be, unfortunately, very, very busy.
Okay, so you've got some nice tools here for insolvency practitioners. Let's find out how the process started and
sure.
how.
So what? What? You need to switch back to me, perhaps. Oh, there we go. Done. So this is back to the story. So we bought into Cerebrum, where we were. So the case study for us was that when we invested, we'll come on to the sort of the profile of that in a minute, is the service was designed. They need to get to market and they need to sign their first contract. This is our mission, if you like, as experts. This is what we're here to help to do. So the minimum viable product was built, a few little bit of fine tuning, but fundamentally ready to go. The not commercialized line is it basically they didn't have a rate card, didn't have a service contract, didn't have the key components with which to contract with the end client. So in the middle, the anchor client's known. It's an excellent anchor client. It's a leading anchor client, and they want the service and they're coaching in order to get them across the line. So perfect situation. So what I'm help them to do is to bridge this MVP into a commercial solution. So the first point we started was with the rate card and getting that to look right, so they can monetize their activity. So obviously units equal drivers. And then in the original business case that we obviously invested on, there was 23,000 new cases to come in as a result of that first contract, which is sounds like a lot, but it's a decent chunk of the market. But there we go. So that's basically where we got to. So I'll now share with you our impact. So on the left we have where we were. So the pre-money valuations in the public domain, so we can share that. It was 4 million. So if you look at the left column, you see the pre-money, and where we got involved, the MVP was built. It was yet to commercialize. Consilience Invest, anchor client identified, as I discussed. So, and the valuation range. Now, the valuation range, we have some growth and we have some enterprise value at the end, and we play around with that a little bit. So it gives us a range. So low end, which is sort of like zero growth, was 3.3. High end 4.3. And in order for us to hit that with the metrics that we're using and the way that we value, was a 30% risk. So basically a 1 in 3 chance.
So to understand this, the company approached you, and as they approached you, the valuation was in the range of 3.3. That's right here at the bottom.
Yeah, to 4. Range. Yeah, and the pre-money valuation that the deals the round closed on was 4. So it was in a range, a 30% risk range for us.
Okay, so the value add the experts provided here was to model the future cash flow streams and actually bring cash into the company and to make it cash positive as quickly as possible within the 180 days.
No, well, what we've got here is we've got the start point. So this is, if you like, the investment cycle from an expert's point of view. So we bought in
commercialized risk.
The middle column and the end column are the actions that we're going to take.
Okay.
So design the rate card, complete a master service agreement, make sure there's a draft written contract with the anchor client, and just be ready to go, ready to contract, which obviously they weren't when we bought. The anchor client secured headline terms and agreed in principle. So at that point, we've de-risked this business slightly. We haven't changed the profile. It's still 23,000 cases. We haven't changed the go live date. Everything is exactly as we invested. So we've just made it less risky. We've moved it forward. And based on our risk profiling, that's about a 5% movement. So you can see at the bottom, it does a couple of things. It consolidates the pre-money, and it may give us a little lift. But really at this point, you're part way through the journey to being a live business. So the next point is to contract. So at the contraction point, master service is signed, 23,000 cases are on board. Or they start a migration, sorry. So those 23 cases are coming. And over a 60-day period, you can migrate pretty much most of those on. Then the workflow is in place. It's in place with the client's using it, you're supporting it as a cerebri on the business. And then then the service goes live and it's stable. The most important thing is you're doing what you said you're going to do, when you're going to do it. So now what you have here is effectively an annual growth, an annual 23,000 coming in, a stable service for 3 months. The workflow is in with the client. You're embedded with the client. That's just de-risk the business again. Because at 23,000 cases, this business is pretty much cash neutral or cash generative, sort of in the middle somewhere. So that is a key moment for them, because they go from being maybe a 30% risk to a 20% risk. They've got 1 in 4 chance now.
Mm-hmm.
So they're far more likely to survive and grow and be successful. So you can see here, we bought in at 4, and at the high end range, and I can tell you that's about an 8% growth out into the future, which, given the debt numbers that we talked about earlier, 300 to 380 isn't, and you imagine the fail rate and the insolvency mapping against that, that's very doable. In 180 days, we've gone from 4 to 10. Now, obviously, that's on paper. It's not for sale, and there's much more to do. And there's other deliverables that are needed further down the line in order to make that 10 firm. But based on that execution, that's the sort of impact that it has.
Right.
So in italics, you'll notice I put 50,000 legacy cases, and I did jump over that. And the reason is that within the business case, those 50,000 legacy cases are not in. When the model was built and signed, Cerebrion started literally with brand new clients, and I guess they just didn't really think about it, but there were at least a year, if not 2 years worth of cases that would need to go onto the platform in order for the real benefit and the efficiency of the workflow to be across all the live cases. So actually, the 10.2, assuming they sign the deal, assuming the 23 are coming in, along with the 50,000, that's 3 times the volume that they thought they were going to do. And you can replicate that across every single deal in the model. So our assessment is that there's they'll be doing 3 times as much business when they get to the sale point than they thought they would be doing when we bought. And that came out as a result of the workshops that we were doing around following the life cycle and following the cash.
Good. Whilst we're going through this, if you have questions that pop up, please put them into the chat, and we can get to them in the Q&A section, which will follow shortly. So that's great. I think we see how the experts with domain skills can augment the services of an existing business, and provide some guidelines on best practice on getting cash through the door, for managing that cash flow, and for increasing the valuation through de-risking, but also some of those principles that may not be available within the startup or the scale-up, but could be available within a highly skilled ecosystem of subject matter experts that can be drawn upon, based upon time, availability, and capability matching.
So that's the story of Cerebrion. So let's, I think, possibly the advantages for the experts. And we thought we'd just talk about this piece a little bit and just say, look, that profile that you saw of Cerebrion is the profile that we're looking for. We're looking for companies that are going to go. The time horizon can be different. Obviously, if you're doing a medical solution, that's obviously a lot longer than the position they're in. But we're looking for that go. The CBDS, I put sort of further down the bottom. I consider them to be similar to a unit as a unit in a fund. I don't see it any different than that. And what I like about it is that I participate in the total portfolio growth, not just the ones that I work upon.
And so for those of you that weren't on the previous webinar, I encourage you to take a look where the CBDS was explained. Essentially, it's a unit of digital currency. It's a token which represents value of the network, and value which is then, as Mark just mentioned, can be considered very similar to how an asset-backed fund or unit within that fund would be valued. But it's valued with some principles that value the whole ecosystem.
And also, I think the other point is, because you participate in all the portfolios, there is no competition really between experts at all. If you get a call to help, to give some advice, you give it, if you're invested in CBDS, it's in absolutely your interest to make sure that those companies are successful. We feel completely aligned. So we better have a quick look at this. The expert network.
One point to remember is that experts can be remunerated both in the token as well as cash, depending on the way the contracts are designed, which I think is quite important. Some consultants do want income, and some other consultants would want future growth in the digital asset.
Yeah, just to be transparent, I have a blend on all the ones I work with. So, and the blend varies between them, and it also, I balance it also with other income from other clients. So I know, personally speaking, I want to get to about 80-20, where, so I do maybe all my investment work I do with Consilience, other cash work I do with others, and a blend in between. So that's what I'm trying to personally achieve, but everybody's different. You may have a larger business that generates all the cash you need, and you just want to do investment work, and that's completely fine. It's entirely what works for you, and obviously what works for the startup. So expert networking, the collaborative piece we've touched on, the value creation focus. We were all playing around with Cerebrion. Some of the revenue started sliding right, and I just showed them the impact that would have on them personally, and they slid back left again. It's curated. I mean, that's the most important thing on both sides. Really important that the experts are curated, and you're lined up with those values. And on the other side, we want to be working on companies we can deal with a project in the way that we have with Cerebrion and add that value. I think we've described it as, it is no different than property development. You're looking for something that needs this expertise in order to create the value. That's really, because that's a perfect fit, and obviously the founders need to be coachable, and they need to want to work in that with that support, and the support is lifetime support as well. Kevin touched on that last time.
So we're kind of running into the Q&A section. So if any of you have any questions that you'd like to ask, this is now a good time. I think a summary and a recap from my side, just to kind of put a top and tail around it. The venture model digitized with a token and distributed as such within this kind of VC network is a really interesting model to explore. It combines the experts on the one hand who may have surplus capability, and in these times there are many people that have some amazing talent and skill, but because of the lockdown unable to kind of utilize it at the right time. There could be a good opportunity for those experts to share their talents and wisdom, and there's a match between the companies that are being supported. It would be really a good way to do that kind of matchmaking. Secondly, on modeling, the importance of cash. I think one of the key models is, can you get to cash fast? So one of the questions I have naturally is, many of these really large companies that are valued as unicorns, they're not making cash, and their model on paper on the one hand is very large based on future projection, but they're getting to cash very slow. So interested to know, how that balance is catered for. Any thoughts and opinions? And by the way, if anybody wants to join the conversation, you can just unmute yourselves and put your video on, and you could kind of take a look as well.
Well, I certainly from my perspective, they're just different assets. So you do the piece around what's actually going to happen to the business, what's the funding that's required, so you get the actual financial route map. Some of the asset creation, I've certainly seen it in other sectors. It's the underlying data and what you can do with it, and it's valuing that piece as a separate unit, I think, is the important piece. And there is a measure which is profit after or return after client acquisition, which is another important number.
Okay, we have a question.
If you're driving value there, and you're sorry.
So we have a question from Ronnie Stafford. How do you value any contribution made by an expert?
Right. Well, the way that it currently works is that, let's assume you have a day rate. The day rate is each CBDS is currently valued at £10, and your day rate is converted into CBDS and paid to you through your wallet, and it appears there. So therefore, you have an asset. So as you contribute to the startups you're working on, as you saw in my graph on my slide, you can see that whilst it's obviously not materialized, the value has moved as a result of our work. So what you would expect to see is, as the model matures, is a regular revaluation, and the units should be increasing, all being well.
And then as the startup or the scale up has an exit, then that would then get passed down through all of the invested members.
There's a mechanism for that. Which Kevin's probably better placed to explain than I am.
Okay, feel free to ask any more questions as you come up to them. Could we maybe flip up to the next slides as well whilst you're thinking, and we can give you a prompt of what's coming up in the series. So the next week's session is investing in AI, and we have two experts that are renowned authors and speakers. The tickets are up on Eventbrite. You can take a look at the bio. And AI and data science has become almost mainstream now. Most startups are using them inherently. So what is it that you need to look out for? And what are some of the guiding principles behind investing in AI startups? There'll be two experts that are joining us there, Pierre and Ruban. As I say, you can check it out on Eventbrite. We then have a session on healthcare and medtech. What are the trends that we're seeing in the medtech industry? And Dee will be joining us there. Space tech and sustainability. So those, go have a look on Eventbrite. We'd love to see you again. We'd also like to take your feedback and comments, and ultimately, I think the purpose of Singularity University, CV, and other members in this ecosystem is to figure out a way of how we can all help each other, and how we can contribute our talents and capabilities to become the sum of the parts. And if we can do that well, then we're using human capital and tech capital effectively in order to solve some of those pressing problems. So some other questions are, CBDS, is it shares or coins?
Kevin,
Kevin, I think, has answered that, saying it's a token. Yeah, Kevin, if you're there, you could add more to it. And then
we also covered this this bit at the last presentation, but it's actually a token. It's a security token, essentially.
Thanks for that. And then Christoph, Mark, could you elaborate on how you would reconcile a valuation for a startup made by CV and the valuation made by another venture capitalist? So obviously there's going to be different valuation models, and how do you catch the gap and account for it?
Well, that's a tricky one, isn't it?
I can cover this one if you want, but this is going to be, I mean, this is obviously transparent. I will let you answer to this because you obviously, a key part of how we're looking at those principles, Mark. But for the sake of everybody here, it's important to say that actually there is no level of asymmetry information between the network members and the way we look at those assets. Consilience Ventures is not a market maker, and essentially we are collectively looking at the principles and the assets under management, and we collectively look at the best formula to come up with the most appropriate way to look at the value of the CBDs. For those who have experience in fund management here, it's typically very close to AICPA fair valuation mechanisms in traditional VC world, basically. And I don't know if you want to add more into this, Mark, but what's also important to note here is that part of the way CV is evolving is capturing a lot more data than what most other portfolio businesses can have and can take a look at. And this should also be considered in terms of valuing the CBDs.
Okay.
All right, great. I think we've covered all the questions. And we did have until 40, so I'm conscious that we've run out a little bit of time, but if you would like to get in touch, then there are some screens on contacts, Mark. There's contact information.
Yeah. There we go. There's Consilience. And then there's,
so if you want to connect with Singularity University London, we have a members portal. One of the things we're trying to think about is, can we run an online hackathon or an online, some kind of mechanism to bring the whole ecosystem together, and we'd love to hear your views on that. You can follow us on Facebook, Twitter, there's a newsletter, and then there's also a website where you can actually join up and be part of the wider SU ecosystem. And then there's a LinkedIn to me as well. I'd love to connect with all of you. And yourself, Mark?
and there's me.
So if you have any questions on valuing startups and cash flow modeling, there's some pointers for you. So I'd just like to finish by saying, thanks for offering up your time. We're in very unusual circumstances, and it's so nice that we have such a fantastic network of creators, of capabilities, and of skills. And in this unique moment, over time, I hope that we can work together in some ways and build something really inspiring. Thank you very much, everyone.